Well, Mario and Nick, you're both in the UK, so I trust you're both keeping well. It's nice to see you again. So, we've been talking a lot about what's going on in the UK relative to tax authorities thinking about multinational enterprises, both UK headquartered and non-UK headquartered. Fascinating stuff. Tell me a bit more about that.
Yes, so I would say over the last 5 years or so, we have seen the UK tax authorities, HMRC, really focus on the key objective of the OECD's BEPS initiative, at least phase one of that initiative, which is very broadly to ensure that multinationals pay tax where they carry on economic activities. So in that vein, HMRC has been focused on ensuring that foreign multinationals pay tax in the UK if the activities giving rise to their profits are carried out in the UK. So we've seen a lot of scrutiny of multinationals' transfer pricing, thin capitalization, i.e. excessive leverage, and perhaps permanent establishment, taxable presence type exposures. So just to illustrate that, as an example, the tax take, the statistics published a week or two ago of tax take from HMRC inquiries show that transfer pricing, thin capitalization inquiries generated 70% more revenue for the Exchequer last year, in the year to March 2020, compared with a year earlier. That's 70% extra, which is an enormous increase. So, so that's as far as transfer pricing and thin capitalization and so on. At the same time, the government and Parliament have, let's say, put through some legislative changes that in some ways go beyond the existing transfer pricing paradigm and look, still trying to pursue the same objective as the BEPS agenda, but basically go beyond the existing arm's length principle and permanent establishment rules. And so, for example, the diverted profits tax rules were introduced in 2015. And what they do is basically two things. One, they introduce a tax charge in certain circumstances on foreign multinationals that basically artificially avoid creating a UK taxable presence. So if you avoid having a UK permanent establishment, and the way in which you do that is regarded by the rules as artificial, then basically the foreign multinational may not be liable to UK corporation tax, but instead it has to pay this diverted profits tax. The other scenario in which the rules apply is where the transfer pricing may be arm's length, but the profits of a UK company have been artificially diluted or depleted, for example, as a result of deductible expenses or a reduction of income. That could be, for example, an IP migration that the rules treat as artificial, again, that being the key word. Again, the reduction in profit may be subject to this diverted profits tax. And then 3 years later, in 2018, further rules were introduced regarding so-called offshore receipts in respect of intangible property. And what those rules do is subject to UK tax, to the extent that it's not already taxed, any income from exploiting intangible property, IP, that enables, facilitates, or promotes UK sales. As you can see, that's a very wide wording, and basically where that IP is located in a country that doesn't have a full double tax agreement with the UK, these rules seek to tax it, basically. So the PDCF initiative, the Profit Diversion Compliance Facility initiative that we're coming on to, has to be seen in that context. And Nick Stevart is the expert on that, so I let him speak.
Okay, thanks, Mario. Yeah, so as Mario explained, it's very clear that HMRC continue to see widespread risks in the amount of multinational enterprise profits that are taxed in the UK. Although they've introduced legislation to counter some of that, a lot of the issues are around factual detail on the ground, actually, and typically HMRC will intensively test those facts. In my opinion, the DPT, or the effect of it, was actually to encourage businesses to cooperate with these investigations and to modify their transfer pricing. And I think it's fair to say that HMRC were largely successful in this. And being successful, it's given them a business case to carry on with these investigations and to do more. And this is really the context for the PDCF. That's effectively an operational response that was launched early last year to encourage some of those multinational enterprises to rectify or clarify their position in a formal report that's submitted to HMRC before they are investigated. So HMRC published some risk indicators to help people identify who they might be looking at, and they've also issued some nudge letters to some of those people. Ultimately, although the PDCF talks about all international tax risks, the core focus is really, in most cases, transfer pricing, so the allocation of profits to that part of the enterprise. All legislation, though, is considered in those reports. I suppose someone may ask what the benefit of the PDCF is. So the benefit, I think, for HMRC is that it frees up their resources to focus on other taxpayers. It gives them greater coverage of risk. The benefit for the business is effectively that they have more control and less disruption in the PDCF, as opposed to the alternative, which is going to be normally an HMRC investigation. And the process is also accelerated for all parties, which aids the efficiency. I think it's fair to say that the PDCF is not appropriate for everyone, but the guidance itself that HMRC published last year has very wide relevance. And that effectively means that most multinational enterprises should be considering their arrangements and how they would deal with an HMRC investigation if it were to come. There are a range of options in how you deal with it. It doesn't necessarily mean that you should register for the PDCF, but often there's particular actions that are worth investing in upfront rather than at the time of the HMRC investigation.
So just fascinating both. So you've got a backdrop of changing legislation and almost changing emphases, and on the other hand, we've got this option that multinationals have to almost come in and have an upfront discussion in a way that perhaps is more productive than the traditional examination route.
Yeah, that's exactly it. And I think it's an interesting development. And you might say, or the question might be, are other tax authorities going to follow suit? Because initial indications are it's probably been quite a successful initiative for HMRC. So even if they're not collecting more tax on some of the cases, they're actually getting a lot of intelligence and they're saving a lot of their resource costs, and they can then apply these resources to other cases, so people that don't want to come forward.
Well, that's a very interesting thought as to whether this might just migrate to other countries. Well, gosh, so both of you, this is fascinating. I mean, clearly, I guess a message for folk is if they haven't considered this, given the backdrop, Mario, that you were talking about, maybe this is something they should have a discussion with folk about to decide if it's an appropriate next step for them or not. Perfect. Well, both, thank you very much for your time. It's just great to see you both again, and please stay healthy during this COVID time.
Thank you, Rodney.
Thank you
too.